point in all this is that's not a failure of the strategy. The strategy has variability in its beta, if you will, to the S&P or to risky assets. Momentum, long-short momentum is another one where, depending on the characteristics of equity markets, long and low volatile versus bear and very volatile, the characteristics, depending on the portfolio construction, obviously, but generally speaking, are variable. You can't expect it to be, by definition, a negative beta crisis alpha product. It depends. You just don't know. And so when I started to classify the strategies, I determined and created 4 strategies, four monikers for bucketing everything. One is a booster, so something that performs well when equity and risky assets, risk on, is working. A defender, which goes the other way, which performs when equity markets and we have sort of these risk off periods. And then you had the non-correlated assets or strategies to the S&P. And those were a little bit trickier because, again, on one hand, you've got time series momentum, which, depending on where we are in regimes, they could act risk on, they could act risk off. It will depend on where their signals are, versus, say, gold or a long short value strategy, which typically is a little bit more a little closer to home in terms of correlations always being near zero. And so I split the lowly correlated strategies into 2 monikers, one being a selector, so something that selects its beta, if you will, over time based on the strategy. So managed futures, trend followers fell into that. Long short equity, factor momentum fell into that. And then you've also got what I call the true diversifiers. So things like gold, remind myself what exactly fell into that bucket. Yeah, gold, equity value, equity quality from the factor side. And again, it was a nice idea to classify every single strategy. But when you get into the paper, there's a graph that I think is the proof in the pudding, where you look
at the correlation versus the standard deviation or dispersion of correlation. Exactly. I really like that framework. Yeah.
Right.
Yeah, say more about that.
That's the framework for deciding which bucket something falls into, a strategy falls into. But then right below that, we look at the average correlation over time, depending on the buckets. And what you find is that the boosters are very consistently correlated to the S&P 500. So call it correlations of 0.6, 0.8. They don't really move. The defenders.
Lars, why don't you try and go ahead and share your screen on that? I think it would be useful to, and if you're struggling with it, I can share it too.
Yeah, actually, if you want to try to give it a shot.
Sure. Yeah, I'll share it. So
I'll go through it. But the idea is when you actually looked at the correlations over time, not over the full sample, but a rolling window of 1 year, they behave as you would expect. And that to me gave me a lot of comfort that this is probably the right way to classify the strategies.
Yeah, agreed. So hopefully, you're seeing, I think this is the chart that you're referring to, right, correct, Lars? So maybe you can kind of walk through how to interpret that chart.
Sure, exactly. So this is a time period from 2008 to 2019. I picked, I believe, 19 either asset classes or strategies. Nothing particularly selective about them, just a representative population of things that are being traded in the mainstream these days. And I took the weekly correlations or the weekly returns of each return stream and calculated a 52-week rolling correlation between each of those assets and the S&P 500. I picked S&P 500 just as the sort of risky
equity beta or risk on proxy.
Yeah. Exactly. Nothing wonderful about the S&P versus like in MSCI All World. That was just the proxy I picked. And so we've got the 52-week rolling correlations for each strategy or each asset class. So from
that's
this
on the y-axis.
Yeah.
Okay.
So from this, I take the average of that correlation over the 10-year period, and that gives us essentially the average beta correlation. Is it risk on? Is it risk off? And if you look at the top, you will see assets up there that you would expect. international equities, a short volatility strategy, high yield in REITs, which, again, one of those that when things are calm may not look very equity, but when we hit periods of stress, those assets do become very equity-like. On the other side, the assets and strategies that had negative correlation to the S&P 500, not really surprising, a long volatility strategy, an equity low volatility, which was actually a dollar neutral, long low beta, short high beta. So, ex ante by construction, short beta. So no surprise there. And then long rates, which was, a longer dated US Treasury total return series. So those, with the average correlation of the S&P 500 below negative 0.3, defenders. Those with average correlation to the S&P above 0.3, boosters. So you're left with the stuff in the middle, and this is what we were talking about before, but they're not zero correlation to the S&P, but they're also not terribly, terribly high. And so the classification system was based on the x-axis, which is the volatility of the correlation, meaning, so if something is never moves with the S&P, not only is the average correlation over time very low, but the standard deviation of that correlation will be low too. Let's say you've got a different strategy that picks a long or short on the S&P, flip of a coin, you name what it is, and it does it for 10 weeks in a row, and then it flips a coin and goes the other way. Well, that average correlation over time, just because sometimes it's long, sometimes it's short, is going to be near zero. At any point in time, it's correlation 1 or correlation -1. So again, it randomly flips a coin. It says I'm long the S&P or I'm short S&P, and it does it roughly equal amounts of time over the period. Your average correlation is in fact going to be zero, but at any point in time, your correlation is going to be +1 or -1. And so when you look at that variability of correlation over time, it is going to move in a rolling 52-week time series point of view. And so the split between what I call diversifiers and what I call selectors was based on the consistency of that correlation. So for the assets that weren't correlated very much to the S&P over time and intra-periods didn't show much variability, I call those diversifiers. For the other assets, which over the average don't show much correlation to the S&P, but have very high variability of sometimes they're correlated and sometimes they're very much not anti-correlated, those I considered selectors, and those have a higher standard deviation of the correlation there. And so that's the framework for creating each of the 4 classifications of the structures.
And then I think this chart really demonstrates the merit of that framework, right? Where you've got, really it just shows that the different categories exhibit the exact characteristic that you are going for when you divide it using this framework of average correlation versus standard deviation correlation. So maybe just spend a quick minute going through this just to illustrate it.
Sure, and this is, like I said, the proof of the pudding. So the sort of navy blue line that's on top is the average correlation of the strategies that were considered boosters in the previous graph. And they are positive, and they are consistently positive. They are risk on, and that's just what they are. The very, very light blue line at the bottom is the average correlation of the 3 defenders, that being rates, the equity low volatility, and the long volatility strategy. They are negative, and they are negative throughout. They don't really move. These are risk-off assets. Where the interesting results lied are the purple line, which are the selectors, which are the ones where that variability moves. It gets very high and it gets very negative. You can see the average of that purple line over time is kind of near zero. But
one thing that really stood out to me, just parenthetically, is just how regular the periodicity of that purple line is.
It does feel sine wave-ish, isn't it?
It could be just the time period, but that is astonishingly regular.
Yeah, but
sorry,
you see,
continue.
Sure, but you see the variability of the purple line of the selectors. They at any point in time, you throw a dart at this graph, they may very well be risk on, or they may very well be risk off. Whereas that middle line, that sort of light blue line, is the average correlation to the diversifiers. It doesn't move. It doesn't budge that much. 0.2. It's very consistent. You throw a dart there, you kind of know where you're going to get.